We've done stock valuation, we've done capital budgeting, and we call the discount rate there the cost of capital, the company's cost of capital, or the investor's required return. But we haven't yet seen where that number comes from. So now it's time for that. But before we can answer that question, we need to approach this much more generally, starting with the concepts of risk and return. So let's get started. All right, so the big question is, where does WACC, weighted average cost of capital, come from? So the way we're going to approach this is at the very end of this part of the course, we're going to see that weighted average cost of capital is sort of a weighted average of cost of debt and cost of equity. And if the company has other financial securities issued, like preferred stock, for example, then cost of preferred stock enters there as well. But we are going to focus mainly on debt and equity. So weighted average of these two things. And cost of debt, as we remember our debt chapter, we have a fairly good idea about the required returns of bondholders, for example, or in loans, the required returns of the lenders. We talked about the interest rate risk, default risk, and all of that. And generally, the yield to maturity on those bonds issued, for example, is a good the indicator of the cost of debt. Now, there's going to be a twist there when we get to weighted average cost of capital. It's not going to be just, for example, yield to maturity on the bonds. There are going to be some tax implications and stuff like that, but we're going to get to that later. So the other, though, missing part where we haven't talked about it at all is the cost of equity part, so the required return of shareholders. So think about this. When you invest and say buy a share of Amazon, what's your required return for holding that stock? I mean, there has to be one because you're taking on a certain amount of risk. You have an opportunity cost. There's time value of money. But it's not observable, right? So this is going to be the difficulty in this part of the course, is try to get at that invisible part, hidden part in investing in stocks, is what type of return, compensation, reward investors require when they are making those risky investments. And another complication is there are many, many, many different investors, and from the same stock at the same time, they may have very, very different required returns. So we need to think about this at the market level, not at the individual level, where it can vary from individual to individual. But there's one given market price for each stock at any given point in time. So what's the required return that determines that price, right? And this may be a bit of a weird concept, like required return, cost of equity. What is cost of equity? It's not quite like cost of debt where there's interest payments and the interest rate. So there it's much more obvious. Well, with an Amazon, what is cost of equity? I'll think of it as, again, remember from what we did in valuation. So that cost of equity is the discount rate when applied to those future forecasted cash flows that the company generates, that determines the price today. And that's why it's cost of equity, because if that number is high, if investors are worried because the stock is particularly risky, they are going to have higher required returns. So they are going to discount future cash flows at a higher rate, which means a lower price today. So for example, if the company wants to issue equity today, they are going to be able to do it at a lower price. So to raise a certain amount of money, they need to sell more shares, which means existing shareholders' ownership will decline when the company needs to issue those new shares. That's one example. Another example is that's the same discount rate we use in capital budgeting. So investors' required return is high. The company will have to refuse certain projects with expected returns that are not quite as high. So that's the cost of equity, right? If you need to generate high returns for your shareholders, and if that makes you turn down certain projects, that's costly as well. All right, so that's what we are trying to get at here, that cost of equity. Now, where does that come from? As all financial investments, the required return is a combination of time value of money, opportunity cost, inflation, all that stuff. So those are going to be captured by the risk-free rate at that point in time. And then depending on the context, depending on the setting where we are doing the analysis, we can use different proxies for the risk-free rate, but it's going to be generally a treasury security. So borrowings by the US Treasury are considered as close to risk-free as possible. as there is. But the maturity, which is it a 3-month T-bill, 1-year T-bill, 10-year T-note, so it depends a little bit on the setting. So we're going to talk about that later. But then we have this risk premium part, right? So required reward for taking on risk, being exposed to risk. And as we've seen, risk in stocks can be quite substantial. In particular because shareholders are the residual claimants. So any variation in the cash flows of the firm will have big impact on free cash flows, and then will have big impact on the value of equity and then the share price, right? So what is that risk premium, right? So to be able to figure out that required risk premium for investing in stocks, we need to have a good handle on the amount of risk involved. And that's a harder question than it might seem at first place. So how much risk are you exposed to when you buy an Amazon share or Tesla share? So this is going to involve quite a bit of discussion. And one big thing is going to be the amount of risk you're exposed to. It really depends on what else you're invested in. So we're going to get into portfolios, right? An Amazon share in isolation is a very different game risk-wise compared to an Amazon share in a portfolio with 500 other stocks. Okay, so we're going to look at how we can quantify risk. We're going to come up with different measures of risk, and once we have that, we are going to relate that amount of risk to required returns using a model. Okay, so this is going to be the most sort of subjective thing we will have done all semester long. Because again, these required returns are not observable. It's not like in bonds where we can observe the yield to maturity. We cannot observe required return of shareholders or cost of equity. So we're going to have to talk about theories and hypotheses and stuff like that. Okay, so that's going to come later. Now, during this journey, we're going to do some abstract stuff, some strange stuff. But in the meantime, we're going to encounter some really interesting and important questions, and we're going to answer those. So the journey, not just the end result, the destination, which is weighted average cost of capital, but the journey is going to be important and interesting. So what's that journey? What are some of the big questions? We're going to talk about, to start with, how we evaluate the performance of investments, right? And the language of finance is returns. So we're going to talk about returns as our measure of performance in financial investments. So that's going to be important. So we don't really talk about price changes, right? Sometimes financial press talks about price changes, but ultimately what really matters is the return on investment. And then from return, we're going to go to risk. How do we measure risk? How should we think about financial risk? And we're going to come up with two very important but different, related but different measures of risk. One is volatility of stock prices, and the other is going to be something called beta. That's very important. Okay, so once we have our risk measures in place, we're going to start to think about, look, risk really depends on what you are doing with other investments, as I just mentioned. So that brings portfolios into the picture, and that brings diversification, magic of diversification into the picture. Okay, so we're going to talk quite a bit about diversification. Why is it important? What kind of an impact it makes on portfolio risk? And then that brings up the question of, okay, so we diversify, but there are different variations or different magnitudes of diversification. So what's the optimal portfolio? So the most optimal, so smartest, most knowledgeable investors, what kind of portfolios should they put together? Okay, so we're going to talk about the optimal portfolio, and the answer will turn out to be what we will call a market portfolio, which is an important concept. Okay, then we're going to look at this portfolio. We're going to look at all these stocks, and one thing we're going to notice is, and you may have noticed this yourself, stocks tend to move together a lot. They go up and down a lot. Not always, not perfectly, but they move together a lot. Okay. Even stocks that you might think should not be very closely related, for example, a retail company like Walmart or Target, and a biotech stock, on most days they're going to go up and down together. So that we call this, there's a market factor here. There's a systematic factor, right? And then we're going to call the risk that results from this systematic factor, we're going to call it systematic risk. So we're going to talk about different types of risk. One type matters more than other. Okay. And then we're going to say, okay, now we have an understanding of risk and types of risk. How does this now relate to stockholders, shareholders' required return? And therefore cost of equity. That's where the model comes into picture, and we're going to talk about the capital asset pricing model. So that M stands for model. Okay. And then once we have that, once we have our cost of equity, boom, we put it in the WACC equation and we have our weighted average cost of capital. Now we can take that thing and plug it in our DCF stock valuation or plug it in our capital budgeting. And we've gone full circle. We valued stocks, we valued bonds, we valued projects, taking into account all the risk and time value of money and everything, and the journey will come to an end. Okay, so let's start risk and return.